The Asian financial crisis, often called the East Asian financial crisis or the IMF crisis, was a watershed moment in late 20th century economic history. From mid-1997 to 1998, it swept across Asia, leading to currency devaluations, market crashes, and social upheaval in a region once known for its economic miracle. But to understand what happened, we must go back a few years. In the early 1990s, many Asian economies such as Thailand, Malaysia, Indonesia, South Korea, Singapore, and the Philippines were experiencing rapid growth. These so-called tiger economies became models for development, attracting huge amounts of foreign investment. Their governments and companies borrowed extensively in US dollars, taking advantage of low global interest rates. Fueled by confidence, asset prices soared, especially in real estate and stock markets. Many of these countries pegged their currencies to the US dollar to promote stability and encourage even more investment. But beneath the surface, cracks were forming. Much of the growth was financed by short-term foreign loans, and many banks and companies were highly leveraged, meaning they borrowed heavily to fund expansion. Meanwhile, banking regulation and oversight were often weak, and risky loans accumulated. Corruption and crony capitalism meant that loans often went to politically connected companies, not always to the most productive projects. In the mid-1990s, the economic winds shifted. The US economy recovered and the Federal Reserve raised interest rates to curb inflation. This made American assets more attractive and led to capital flowing out of Asia. As the US dollar strengthened, it became harder for Asian economies whose currencies were pegged to the dollar to maintain their export competitiveness and defend their currency pegs. Reserves began to run low as central banks tried to prop up. Point came in Thailand. In May 1997, speculative attacks intensified on the Thai baht. Despite official assurances that the currency would not be devalued, on July 2, 1997, the Thai government was forced to let the baht float. Its value plunged almost immediately. This triggered panic and contagion throughout the region. Investors, fearing similar problems elsewhere, pulled out of neighboring countries. Currencies in Malaysia, Indonesia, the Philippines, and South Korea fell sharply. The crisis quickly moved beyond currencies. Stock markets crashed. Businesses with dollar-denominated debt suddenly found their repayments unaffordable. Banks came under severe pressure, and many failed. In Indonesia, the situation turned into a full-blown economic and political crisis, with inflation soaring, widespread unemployment, riots, and eventually the resignation of President Suharto after more than 3 decades in power. South Korea, one of Asia's largest economies, was also hit hard. Chaebol's large family-run conglomerates sculdaples under their debt burdens, and millions lost their jobs. In many countries, the crisis led to severe recessions, fallen living standards, and increased poverty. The International Monetary Fund (IMF) stepped in with emergency rescue packages, totaling over $110 billion for Thailand, Indonesia, and South Korea. In exchange, countries were required to adopt tough austerity measures, restructure banks, and implement economic reforms. These programs were controversial. While they stabilized currencies and restored investor confidence, they also led to painful recessions, increased unemployment, and social unrest. Critics argued that the IMF's conditions worsened the downturn and prioritized creditor interests over local populations. The Asian financial crisis had broader consequences. It shook global financial markets and led to falling commodity prices, including oil. The crisis exposed the dangers of rapid financial liberalization without adequate regulation, and highlighted the risks of pegged exchange rates. It contributed to the Russian financial crisis in 1998 and was a wake-up call for global policymakers. In the years that followed, most affected countries undertook significant reforms. They improved banking regulations, built up foreign exchange reserves, and made their economies more resilient. Many bounced back strongly, but the memories of the crisis linger. Today, the Asian financial crisis is studied as a cautionary tale about the dangers of excessive borrowing, lack of transparency, and the interconnectedness of global finance. It serves as a reminder that economic miracles can unravel quickly and that strong institutions are essential to sustain growth.